Would you like to avoid an audit? My small business clients often mention gray areas, while the CRA only sees black and white when it comes to personal versus business expenses. In this video, we dive into the differences so that you are protected. Why be proactive? So why should you care about your personal versus business transactions? Can't you just submit everything into the CRA and they can sort it out? To answer this question, let's talk about a few CRA audit approaches. One technique the CRA uses to determine who to audit is data analytics. This means the CRA will compare your tax return information to many other taxpayers. If your data has unusual characteristics compared to those in your same industry, then you are more likely to be audited, and this is not fun. You may end up paying significant accounting fees to have a good audit outcome, and it may take considerable time on your part to gather the information being requested by the CRA. Being audited is also very stressful, and you may end up with a nasty tax bill if your documentation isn't lining up with CRA standards. Are you still not convinced you should sort your business versus personal expenses? Well, consider CRA's tendency to enact multiple audits and do deeper dives if they get paid. When CRA draws blood in one tax year, you can bet they'll be returning for more in the future. One example of this is a client we'll call Josephine. Most of the time, Josephine did not keep receipts, and personal expenses were mixed in with business spending. Professional advice was often ignored because she was too busy and taxes weren't her thing. Josephine's audit nightmare began when CRA inquired about a few expenses. Josephine couldn't provide all the receipts, and it became clear to the CRA that some personal items had been expensed, like her personal vacations. These write-offs were quickly denied, resulting in a very nasty tax bill. Drawing blood from their initial audit, the CRA went in for the kill. Audits popped up in the next 2 years, with the CRA digging deeper and deeper every time. Josephine's laissez-faire attitude to the CRA cost her thousands of dollars and taught her an unpleasant lesson about sorting her expenses. Boastful acquaintances may be happy sharing all the personal items they are writing off. They'll gleefully tell you how they are getting one over on the tax man. And yes, they may do this for a year or two, but when the CRA comes knocking, things will go downhill fast. And they are less likely to brag about their poor audit outcome. Instead, be proactive and avoid an audit by sorting your business and personal transactions. This is a great way to improve your financial security as a small business owner. Business write-offs versus personal transactions. So now that we know why it's best to be proactive, what's the difference between a business and a personal expense? Aren't some of these a bit of both? Where's the line? Well, the CRA defines a business expense as a cost you incur for the sole purpose of earning business income. But we know from practice they allow expenses that have a bit of both personal and business components, like cell phone bills and home office expenses. Follow-up guidance from the CRA generally refers to the word reasonable, which isn't super helpful. To provide clarity, I'll share a few definitions and examples I put together from helping my clients navigate CRA audits. But before we dive in, let's go through 2 baselines. Baseline number 1. There must be an expectation that the expense you are incurring will help your business grow. Baseline number 2. The cost of being human, like clothing, is generally considered a personal expense by the CRA. To mix these 2 baseline concepts together, a business expense usually occurs if you change your behavior to benefit your business. Let's go through 2 examples to see what this looks like. David owns a construction company and buys a coffee and a bagel every morning. This would be considered a personal expense because David is not traveling out of town or meeting a client. There is no direct benefit to David's business other than him showing up on the job site with a full tummy. Having a full tummy is a regular part of being human, and David has not changed his behavior to benefit his business. Everyday meals are not something that the CRA will allow you to deduct, so you shouldn't claim them as a business expense. Another example is a client will call Jessica, a financial advisor. Jessica drives to her office every day and must pay for parking. The parking fee would be considered a personal expense because driving to the same work location is classified as a personal commute by the CRA. No change in daily behaviors makes this a personal expense for Jessica. Driving to work is a very common requirement for most Canadians. Because there is no special or unique business-driven action Jessica is taking, the parking fee cannot be written off in Jessica's business. Now, if Jessica changes her daily behavior to benefit her business, like traveling to an elderly client's home for a meeting, then a parking fee at the client's home could be considered a business expense. It is the change in behavior combined with the intention of producing business income that makes expenses a business write-off. Documentation, documentation, documentation. So how does the CRA know the difference between personal and business transactions? Well, it is all about documentation. Mileage logbooks, detailed receipts, bank statements, and credit card statements are all items that the CRA may ask for in the event of an audit. These items help prove the business use of an expense. So the best thing you can do to protect your business from unexpected taxes is to keep your documentation. Now, I have a few quick tips to help you do this effectively. Number 1, for mileage logbooks, please check out our motor vehicle videos available on our website. This helps ensure your vehicle is reducing your taxes rather than increasing them. Number 2, make sure to keep detailed receipts. You want a till receipt or a copy that describes what you purchased. A credit card slip from your barista isn't going to cut it. Number 3, items with a mix of business and personal use, like a cell phone, can be claimed on a percentage basis, say 60%, but you do need the actual usage to be considered. CRA will not allow you to claim 100% and can deny the expense if you get too aggressive. Number 4, as a final tip, if you purchase personal items for your business, say a candle as a thank you gift for your real estate client, make sure to write on the back why the expense is a business write-off. Items that could be perceived as personal expenses are easy targets for the CRA. All right, that is all I have for today on business versus personal expenses. I hope you found this video helpful when deciding what you can write off. Remember, it's the change in behavior to benefit your business that counts. I will see you in another video. Bye for now.